Hey, good morning everybody, it's Mike. Thanks for jumping on with me this morning. We're continuing a conversation that we started yesterday about your money. Yeah, that's a pretty good topic, isn't it? Your money. Yesterday, a little bit of a downer. It was Downer Monday because we started off the conversation talking about income taxes, right? Well, your filing deadline this year is this coming Monday, the 17th. So we needed to get that out of the way, and we needed to talk about who is required to make quarterly estimated payments, who's not. We also talked yesterday about what's the appropriate amount of cash reserves for us, for real estate agents, right? And if you were with us yesterday, you heard me make a passionate plea for 6 months of living expenses. And I say this, and the reason we started with that yesterday, because until you have handled your taxes, and until you have 6 months of cash reserves, living expenses in the bank, if it costs you $5,000 a month to pay your personal bills, then you need $30,000 cash in the bank. Until you have those two boxes checked, you don't need to go to worry about any of the others. We're doing this in order of priority. Okay, so don't worry about any of the other strategies until you have those two. Now I'm going to move along quickly today because I've got a lot of ground to cover with you. Next on my priority list for our money is insurance. Okay, now this is a complex conversation. If you have children or if you have people who are dependent upon your income, they cannot survive if something happens to you and your income stops, then life insurance becomes a higher priority. But if you do not have people who are dependent upon your income, if something happened to you, they would be sad, okay, but they could carry on. Then life insurance needs to move way down to the bottom of the priority list. I didn't say it wasn't important at all. I'm just saying that life insurance is meant to replace your income. If nobody else is dependent on your income, then it needs to move to the bottom of this list. If you have children or a spouse who is dependent on your income, then life insurance comes next on your priority list after this type of insurance. Disability. If you are under 50 years old, it is more likely that you will become disabled than you will die. Now, I know this is a little bit of a downer. I should have probably put this yesterday with income taxes, but if you're under 50, the odds are statistically, if something bad's going to happen to you, you're going to get disabled and not die. So all of us need disability insurance. If something should happen to me today, I still have bills to pay. My mortgage company might be very sad that I'm disabled, but they still want the mortgage paid. So does Georgia Power. You get it? So disability insurance and then life insurance, but life insurance only if you have dependents who are reliant upon your income. Next on the priority list, retirement savings. Yep. And this comes next. Until you have these boxes checked first, don't worry about the other things that are left to discuss. Retirement savings for us as independent contractors can be a self-employed program, a SEP. It can be an IRA or a simple IRA. I'm not here to give you investment advice this morning. I'm here to help establish priorities. Retirement savings will help you minimize your tax obligation and allow you to obviously prepare for long-term savings. This should be next on your priority list, and there's a number of programs that are specific to self-employed individuals. Your accountant or a money manager can be best situated to tell you which is best for you. Some of you now want to discuss, should I incorporate my business? Should I be a Chapter S, a subchapter, an LLC? What's best for me? I will tell you as a rough rule of thumb, unless you are a very high income earner, that incorporating your business is more of a risk strategy than it is a tax strategy. But as your income continues to grow, you'll want to look into that issue. We don't have time to address it today, but it is not one of the top 3 or 4 issues for you. So far, we've talked about making sure your taxes are in order, making sure you have 6 months cash reserves. Those are your top 2 priorities. Then making sure you have disability insurance and life insurance if needed. Retirement savings come next. After that, now we're into debt reduction. Okay? Now, you want to start the process to eliminate debt on all non-appreciating assets. Okay? So what's an example of that? Cars. So my personal rule for me is, if I can't buy the car with cash, I don't buy the car. I don't finance depreciating assets. I will finance and I will borrow to the hilt personally on appreciating assets. Real estate. Cars. No, the second I drive it off the lot, it goes down in value. Every mile I drive the car, it's worth less. Don't finance items like that. If you have debt on items like that, that should be, after credit cards, your next area to tackle. So we're reducing debt. Now some of you are saying, hey Mike, like you're 5 steps into money management now and you haven't talked about investing. That's right, investing's number 6. Why? Don't I want to invest first? Well, if you do the first 5, you are investing in yourself. You're making sure that your taxes are handled. You're making sure that you've got ample cash reserves to handle any disruption that might come along. You're making sure that you're adequately insured in case bad things happen to good people. You're making sure that your long-term savings is in order. And that minimizes your tax obligation, which will help you with investing. And you're minimizing the BS debt that's rampant through our population. Student loans, credit cards, automobile financing, furniture financing. Get that stuff out of your life before you start talking about buying a rental property. I don't want to hear anybody talking about investing in Bitcoin or real estate or stocks until you've handled these first 5 things. You're not prepared to do it. You want to, it's fun, it makes us feel like a big shot, but we don't have our house in order yet to do it. If you're saying right now as I'm talking about this, Mike, I don't have any leftover money each month to do any of these things, then my message to you today is then your lifestyle is exceeding your income. You might not feel that way, but it is. You're living a bigger lifestyle than you can afford. Reduce your lifestyle so that you can pay yourself first every month, that you can do the 6 priorities every month because you do have some money left over. If you don't like that answer, then my big answer for it is then increase your income. Get in here, sit down with me. Let's build an audience and a strategy for you so that you can sell more homes this year and you can afford the lifestyle you've already created and you can start to get your house in order with money. If you want somebody to follow on a daily basis, here's my big tip for that. Dave Ramsey. I love me some Dave Ramsey because it's very down to earth, common sense, practical, good advice. And here's my little Dave Ramsey tip for today. How do I know how much car I can afford? So Mike, there's a lot of people out there that say, I need to dress for success. I need to fake it till I make it. I need to have my Porsche so that people will think I'm successful. And I say, okay, well, that's total bullshit. And stay as far away from people that say that kind of stuff to you as you can. Okay? What kind of car you drive, what kind of clothes you wear doesn't make you successful to people. As a matter of fact, it's probably pushing a lot of people away from you when you show up in a car that costs twice as much as their car. What do you think the natural reaction to that is? You make too much money? So how do I know what kind of car I can afford? Well, Dave Ramsey has this rule that I've always tried to follow. The total value of the cars you own, your car, maybe your spouse's car, whoever's living in your house, if you have kids that are driving the cars that they have, because that's ultimately on you too, right? Well, my kid has a job and she pays for her own car. Yeah, come on. And if she doesn't, what are you going to do? You're going to have to pay for the car and the insurance. So Dave Ramsey's rule is this: the total value of all the cars that you're responsible for should not exceed 50% of your annual income. So by Ramsey's rule, which I think is an excellent rule of thumb, if I make $100,000 a year, I should own less than $50,000 worth of automobiles. How many of us are following that rule? Folks, money's a gift, and you've worked hard to earn it. Let's make sure we manage it right for our profession. Let's make sure that our taxes are in order, that they're paid, that we have ample cash reserves for rainy days, that we're properly insured, focused on disability first, that we're saving for the long term through the tax-deferred options that are available to us, that we're reducing all this debt that weighs us down. Every month, we're working to reduce that. We're attacking it. And then last, we're investing. Let's do all this, and this is a responsible, mature, professional way to manage our money so that we can go out there and make it happen for ourselves today.